Welcome to the Prediction Show, brought to you by Intuality AI. I'm Dr. Howard Rankin, along with Grant Renier, Chairman and Founder of Intuality AI. We're here to give you predictions and today have a good discussion about the intersection of the coronavirus, the financial impact, and elections. And we are delighted to have with us today Charles Freeman. He's a CFA. He's the owner of Adapt First Investment, a research investment fund. Charles, thank you so much for joining us.
Thank you for having me. Appreciate it.
Yeah, these are very strange times, and there's lots of questions I think people are asking about the economy, the economics, short-term, long-term, and we're going to be discussing that and what you think. Is there some sort of general comment you can make about these times as far as finances and economics are concerned?
It's a really unique time. There's actually, I've been in the industry over 20 years, and I would say, really going back in history, I'm not sure there's been a time where we've had such a disconnect between the market as it stands right now and the actual fundamentals, things like employment and spending, and so that's a very unique time. So it's critical to take a look at that closely.
Yeah, and of course we have the virus too, Grant, don't we?
Yeah, and kind of adding on to what Charles said, I've got a background in grad school in economics, and so I tend to look at some of this from a macro standpoint. The one thing I wonder about, and maybe Charles might have something to say about this, is whether or not the effects on the economy and the markets as a result of COVID is actually something that should be integrated in our thinking and analysis with the normal market kind of analysis that we do. And by that I mean, if tomorrow coronavirus suddenly went away, would we be in fact back where we were before the virus came on in terms of the market and the economy? Or in fact, has it been integrated deeply into the normal business cycle and so forth, and will be there for some time?
I would say that there is going to be lasting impacts, and one of the things, the examples that I think has been pretty clear is the ability to move work to an online space, the ability to use Zoom meetings and things versus in the past there's been more in-person meetings, especially for people who have to travel for their job. I think that there's a lot of companies and professionals that are going to be this transition to online will end up being permanent for many people, and that's going to have an impact on employment going forward and the future workspace. So I think there's definitely lasting impressions.
Yeah, I think you're right. I think a portion of this working at a distance is going to stay with us. You know, the technology has been there for years now, along with Skype and Zoom and all of the various teleconferencing techniques and so forth. And it really hasn't been used to its fullest extent. And suddenly we have, I know that I don't have to travel to the office, which saves me probably an hour a day. I don't have to have the office, basically. So that's another savings. And so that's just a microcosm of what's happening in large corporations, where they may find there's a net plus on their bottom line, both from the employee standpoint and the corporate standpoint, in terms of economics and prices and such coming out of the virus period. So that's going to be something that's interesting. It could, in fact, have a net plus in terms of savings of expenses and effectiveness of working in this manner. So that's a thought.
Mm-hmm. And I would just want to add there, Grant. I think on you're exactly right on the corporate level, but even on the consumer level, when you have something as essential as buying groceries, when now you can buy groceries online and have them delivered to your home, that dynamic is definitely changing. So we saw, over the last few years, you've seen more and more people adopt, e-commerce and being more comfortable buying products through the internet. So I think COVID actually accelerates that trend even more so, and you could see effects on brick and mortar retail and different businesses going forward after this.
Yeah, and we all know, going back probably, I don't know, 5 or 10 years, the number of startups that have attempted to develop this business model where you could order food and have it delivered and so forth, and they weren't successful. But all of a sudden, the economics have sort of forced us that way. And I think that internally within large retail food stores and so forth, by being able, for example, just pick from inventory as opposed from picking from shelf, and all of the economies that come with that, might just push this towards the economics that make sense for this kind of retail business.
Yeah, do you think that's the biggest? It's certainly not the only one. I mean, you guys both have a background in economics. I have no background in economics. You can ask my bank manager, and I'm sure he'll tell you that I don't. But yes, and I agree, this sort of move to remote is definitely going to happen, I think, in pretty much every sphere. Telemedicine, online learning and education, as well as shopping. And of course, there were some brick and mortar retailers 15 years ago who just refused or did not see this coming. And of course, they're no longer in business. So it's pretty radical. Is there anything else that's going to come out with, like, supplies? How is this going to impact, for example, the flexibility of supply chain? And that's clearly one of the things that certainly at the beginning was an issue, that supply chains were disrupted, and that was a major problem. Do you think there's going to be any knock-on effects there, and about how that is done? Perhaps less reliance on international supply chains? How does that work?
Yeah, I do actually think there will be. I mean, one of the things that we've seen really over the last 25 years is globalization and an integration, across the world where, companies are sort of sourcing the place where they can get the cheapest labor or cost of goods. And, but there are risks to doing that. And I think COVID is sort of making people much more aware of what those risks are, especially in the government. And I think, we're already seeing with the China trade tensions that going forward, we might have a decrease in globalization as some of those supply chains start to get more localized once again. And that's going to have an effect on cost of goods, because, a company may have to pay higher, cost, labor and things like that, or materials, to have that convenience of it being more local versus farther away. So I absolutely think that's going to be the case as well.
Yeah, I just add that my wife and I just about 5 days ago decided, let's just order our dinner from a high quality restaurant and have it. We'll go pick it up. They wouldn't deliver it, but we could pick it up in the parking lot. And it's a well-known restaurant in the area, and good quality food. And sure enough, we did that. And I was thinking on the way home, well, what we just did was we picked up our meal. It's all warm, all broken down into making it very easy to serve it. And suddenly the restaurant, they didn't need a waitress. They didn't need the floor space for the table and all of that. So they have to have recognized some sort of economic savings there in cost of supplying a very high quality. And it could be that restaurants might end up, permanently staying with the pick up or deliver model as part of their business, which could have probably a positive effect on the bottom line.
Yeah. Yep. Absolutely. Now, in all of this, of course, is COVID. And part of the problem there is no one is exactly sure, except maybe Grant with Intuality AI, exactly where this is going. The assumption for a lot of people outside the experts has been that it'll pass and everything will open up and it'll sort of go back to normal. But I don't think necessarily that's the case. And I know Grant has his update on the number of COVID deaths that is being predicted by Intuality AI over the next couple of months. And so what does that actually look like, Grant?
Okay, I'm going to bring up the chart, and this is let me go back to the chart here.
Yeah. So this is, we are looking at, I'm talking about predictions that the Intuality has made about the number of deaths moving forward in the US through mid-November. And Grant, tell us what it says.
Okay, well, first of all, it's starting out with the number of deaths right where they are being reported on June 17th. And it shows a steady growth through the summer, whereas before it's been showing a peaking in the summer. It's now pushing that flattening out to the latter part of September, and a flattening at about 138,000 deaths. And this is a little bit in contrast to what's currently being talked about in some cases where deaths are being estimated to be reaching 200,000. But we're going to stay with 138,000, which is close to some other projections that have been made. But then it flattens out for about a month or two, and we see a kick up in the rate of deaths starting in November, which might be the indication of a second wave. And just an aside here is a indication of some calculations we've made on our accuracy in predicting the deaths in the US. And we're showing that the predictions that we made on April 15th, as of the number of deaths that would be right now, was about minus 9%. So we had an error rate of about 9%, but then the predictions that we made on May 15th of where the deaths would be right now in June 15th, it's a minus 2% error rate. So we're pretty accurate. And so we have a lot of confidence in what our curve is showing here.
Yeah, so all those people out there writing on Facebook that all the experts have got it wrong, well, I don't think that we've got it wrong. I think Intuality has been pretty accurate. And just to summarize what Grant has just said, it looks like over the summer to the end of September, there's going to be about 23,000 more deaths as predicted by Intuality. And that, that's over about 100 days. So, the rate of, what does that work out at?
Yeah, it's kind of, I didn't include
Yeah,
it.
yeah, it's, well, if it's 100 days and it's 23,000, it would be about 250 a day. Then it flattens out a bit for a few weeks, and then in early November, it looks like spiking again. We don't know what that is. Is that a second wave or just a spike? At this point, we don't know. Charles, do you have any thoughts on that prediction?
Just anecdotally from what I see, just in my personal life, it's interesting that I have friends of mine who have, kind of just, it's really a full spectrum. Some people think it's a hoax, and then other people don't want to leave the house. So, you see a lot of people out without masks on. So I think that given the variation in opinion about it, and some people just have the resolve of, well, if we get sick, we get sick, but I'm tired of stopping my life for this thing. That, mentality could suggest that, I think we could get a second wave, just because there seems to be a fair number of people who believe that.
Yeah, and also some signs that the virus itself is adjusting and mutating. Who knows? But these predictions seem pretty reasonable to me. Again, I think all of us live in places where you can go into the stores now, and half the people wear masks and half the people aren't, and half the people are walking down the aisle the wrong way, but they didn't know that. And half the people not social distancing, and half the people think it's a hoax, and half of the people think it isn't. And that just adds so much to the confusion, but also the management of the problem.
Mm-hmm.
That's great.
I wrote a piece recently, and I actually looked at the words that were being used. I think lockdown is a horrible word. Nobody's being locked down. They're just being asked to stay at home,
Right.
and no wonder so many people are complaining about their rights because I'm locked down. Well, no, you're not really locked down.
Yeah.
So again, the communication clearly could have been better. Clearly, a second wave, Charles, of significance would really hamper the economy, right?
Absolutely.
Yeah, and we might see as we go through the charts, we might see what Intuality says about the effect of that as we go forward here.
Okay, yeah, but any sort of significant second wave or continuous spike is going to be problematic. Now, to me, it has always seemed that, sure, New York and the Northeast was the epicenter of that, but we're a big country, and it seems to me sooner or later it was going to spread to areas that really hadn't seen much, and that was simply a matter of time, and I think we're seeing that. So again, it's difficult to know. I saw today, I think Florida opened up their bars and restaurants last week, and now a lot of them are closing again because they've had a huge spike in cases. So that's not going to work very well.
Okay, so the next category that we're going into here in terms of charts and predictions is what we call markets and / economy. And the first chart here, Charles probably wants to explain what's happening here.
Mm-hmm. Yes, there is one of the things that I do from a research standpoint is monitor the economy and try to identify trends. And one of the things we've seen over the last 30 years is that the market does seem to track the economy, and it makes intuitive sense. As the economy is doing well, people have a job, their salaries are going up, and they have money to spend, which, it's this sort of positive reinforcement cycle. And that causes companies to do better, and they can hire more people. And then again, it kind of keeps going. And then similarly, when we see recessions happen, unemployment goes up, people lose income. We also see the market kind of dip. And what I'm showing here for those of you who are listening to the podcast is a chart of the Conference Board leading economic indicators. And basically it's about 10 different economic indicators covering everything from manufacturing, working hours, to jobless claims, production, housing, credit. It gives kind of a nice snapshot of where the economy is at a certain point in time. And I've overlaid that with a chart of the S&P 500. And, going back you can see basically through the 90s, we had an expansionary period in the economy, and the stock market did very well, as many of us who were in the business around that time could see. And then at the when the tech bubble sort of burst in 2000, we saw, you know, a recession, and we saw these sort of indicators all go down. And then as we came out of that, going into 2001, 2002, we sort of entered another expansionary period, which again, the market kind of recovered, which led us into the 07, 08 era, where we saw the housing market crash, and one of the worst recessions we've ever had. And then similarly, as we have recovered over the last 10 years, we've seen another huge expansion. And that kind of brings us up to today with the impact of COVID. You know, literally the entire world kind of stopped for a couple of months. And so the economic damage from, you know, as I mentioned, manufacturing and employment, you know, production, housing, all of those things, you know, have really fallen off of a cliff here in the last 2 months. But the market has actually recovered extremely well in the last 6 weeks. And so what we find is a disconnect between where the economic data is telling us the market should go and where the market actually is. And a big part of that has to do with the Federal Reserve. There was sort of an unprecedented stimulus package that came out, and a lot of investors have, you know, bought the market because of that stimulus program. So the question will sort of be, you know, how does that difference reconcile itself? Will the economic numbers bounce back and just continue to go forward like the trend we were on pre-COVID, or will the market come down if we don't get a V-shaped recovery? If this thing ends up, you know, lasting longer than investors are expecting, you know, we may get a further move down. So this, you know, Grant's actually put up another a chart here, and this kind of gives you a little more detail on it. I track in my firm valuation of the markets, and basically how much an investor is willing to pay for the earnings of a company. And, you know, what I found is that you can look at an average of that valuation number, and the farther the current reading gets away from the average, the more likely is we see a reversion back to that average. And as of right now, where the markets are priced relative to the underlying company earnings and broader economic data, we're at +4, over 4 standard deviations away from that average, which would only happen less than 0.006% of the time. So it's the market, according to the fundamental data, is extremely overvalued right now. And you know, the question is can this extreme overvaluation continue, or do we see a pullback to more of an average level?
Yeah, so the big question here is, where is it going? And of course, Intuality has, as in other cases, has made its predictions about the market as it's indicated by the S&P 500. And while I don't like showing this chart, I'm going to show it anyway. It shows a rather dire picture for the rest of the year. The S&P 500 is increasing over through the month of June and July into August, from where it is now up to some higher level of maybe somewhere around 3,200. But then there is a precipitous drop that it is predicting, and it's substantial. It is dropping down to numbers that we haven't seen for many decades, down into the 1,500 level, roughly around September 20, or the middle of September. and then it starts to come back up into the about the 1500 or higher level by the end of the year. I don't know what to say about this other than saying that this is the output from Intuality. I know the error rate that Intuality runs with, depending on what sector it is trying to predict. And so I don't think that this is way out of the picture according to the results coming out of the system.
And Charles, perhaps it really reflects what you were just saying, that this overvaluation, something's got to happen. Either it's got to be justified by the economic indicators or it can't be sustained. Correct?
That's absolutely right, Howard. It was interesting when Grant shared this chart with me, earlier today, because it's something that I've seen, in my research and going back over the years, and I'm a student of the market. So, and again, like the levels that I'm seeing are really unprecedented, and they're not sustainable. So, the question is how do we resolve it from here? And according to Intuality's output, that doesn't look like a good outcome going forward.
No. One thing that could make this change, of course, is heavy involvement by the Federal Reserve once this downward cycle, if it happens, occurs. This amount of stimulus could be substantial and could offset a lot of this. On the other hand, the information leading up to this prediction up through basically yesterday, over the last few months, you can assume that the S&P 500 has been affected by the stimulus that's been done so far. So it's sort of built into some of the numbers. On the other hand, I'll make a point that with a heavy Federal Reserve involvement, this curve could be not quite as dramatic as it's showing.
Charles, sorry, go ahead, Charles.
Yeah, Howard, I just wanted to add a quick note to that. And I will say that, the Federal Reserve has no doubt been extremely aggressive in the way that they've responded to the COVID crisis. And I actually think that they should have had aggressive intervention. However, I will say, and Jay Powell has admitted to that the Federal Reserve has crossed several red lines, and they've even admitted they're not sure what they're gonna do to get back once we've gotten through this. So there's a bit of a moral hazard situation, which concerns me as well. And however, that being the case, from what Grant was just talking about, I would have no doubt in my mind that if we were to see a situation start to unfold like Intuality is predicting, that the Fed would absolutely step up measures to try to stabilize markets, even though that's not specifically a mandate of theirs. It's happened over the last 10 years numerous times, and this time has been no different. And I think the extremes that they've gone to, such as being willing to buy junk bonds, again, kind of has created a precedent. And it would not surprise me if they were even willing to go much farther, to even the point of outright buying equities, even though there would be longer term implications there that would not be great. But I think Grant's right. The Fed will most likely intervene if we were to start seeing something like this.
And a question for you, since you are, an expert in the markets, do you think that idea that the Fed will save us anyway is contributing to the market being a little overvalued and a little out of relation to the economy because there's an expectation that it's not going to get too bad because we're going to be saved? Or or doesn't it work like that?
It absolutely is, Howard. In a lot of ways, investors are completely ignoring current fundamentals right now, with the expectation that the Fed is just basically printing money to throw at this problem, and that in really a lot of ways, U.S. equities are the most attractive thing to buy. So what it's doing is, I mean, yields are at zero, and they've expressed that they're not really willing for yields to go negative. So in my opinion, bonds are in a lot of ways a dead asset class, and are likely to be going forward, because you won't get a lot of appreciation there, and yields are at zero. So you don't get any income as well. If you look internationally, Europe and emerging markets also have their sort of share of problems. And, I think a lot of investors are kind of looking at the U.S. as the cleanest dirty shirt in the laundry, right?
Yeah.
Right. So with all this money that's being thrown at the markets, it's sort of being funneled into the U.S. market. And the problem is, I think, is that the disconnect, because of that, it's creating such an extreme disconnect from the underlying earnings. It could lead to a very harsh correction. Then the question would be, is what's going to cause that? Is a second wave of COVID and more shutdowns, would that potentially cause it? It's hard to say. Possibly a further breakdown in trade, with China. Now, there's tension with North Korea again. I mean, there's a number of risks out there, but it's difficult to know what could be the catalyst that could cause investor sentiment to change. But when it does, it could be particularly harsh because of the overvaluation.
Yeah, and I think that we probably would all agree that one thing that could change this whole picture is a early development in the ability to be able to distribute and scale a vaccination for COVID.
Mm-hmm.
If in fact that happened, let's say in the latter part of the year, I think everything is off the table here in terms of these predictions. I think it could turn around very quickly. So that's the one thing that we haven't talked about. We know that's in the works. There are numbers of companies working on that, both in the United States and overseas. And it's a race to see if it can be done. But if it can be done, and if something could be made available, let's say in the third quarter or fourth quarter, rather, that could change this whole picture dramatically.
Yeah. Now, in all of this,
I would throw in not just the expectation of it being available, and that expectations effect on the markets could be substantial, even if it wasn't distributed.
Right. Now, in all of this, all of these things factor in to an election year, which makes it even more interesting, because obviously there are serious political ramifications for all of these economic issues. And we have a very interesting graphic and information that Charles provided us, so that we had something similar. Charles, do you want to talk about this surgence of the Democratic Party?
Mm-hmm. Yes, it was interesting to me. I was reading the other day on Bloomberg about how the Democrats were, in a lot of ways, didn't look like they would have a real shot at retaking the Senate. But over the last couple of months since COVID has happened, that appears to be changing. And, so right now, I think the political race, which I think investors had kind of written off in some ways, it was from a market standpoint, when politicians have extreme viewpoints, and there were several Democratic candidates that had extreme viewpoints. However, they didn't get the nomination, and so I think Biden is probably one of the more market friendly Democrats. However, I think the consensus seemed to be that he may have a hard time beating Trump in the general election, but I don't know exactly. I'm not sure that I could say exactly what's caused the surge in the Democratic chances, but at least from this chart, it's looking like it's changing, and there could be a real possibility that the Democrats could take back the Senate and then possibly even the presidency. So the next few months will be really interesting, and that could have a short-term effect on the market if that happens.
Yeah, and so a graph that we're looking at shows that sort of pre-COVID, late February, the estimated chance of the Democrats getting a chance of taking the Senate were a little less than or around 30%. But here we are 2 months later, and that has gone up to over 55%. So that's kind of a really staggering turnaround in a few weeks. And Grant, I know that our Intuality AI predictions have also come up with something similar, right?
Yeah, at this point, predictions going forward all the way through in our chart, it shows it all the way through the middle of July, that the Democrats in Congress definitely have a lead. And the lead is approximately about 6 points. And it's fairly substantial. And while each day is up and down, both for the Republicans and the Democrats, that margin stays pretty solid all the way through half the summer anyway. So that's the way Intuality sees it at this point.
And we've also had charts recently showing Biden doing pretty well against Trump too, with a good chance of winning, correct?
Yeah. We've got currently Intuality sees Biden leading Trump by about 4 or 5 points. And that's been pretty consistent now for a number of months.
Charles, what do you think, as far as economics were concerned? Let's suppose the Democrats did win sort of a clean sweep and Biden was elected and they took over the Senate. What impact do you think that might? I mean, I know it's difficult to predict because you don't know exactly what their policies might be, but could you hazard a guess what impact that might have on the markets?
I would say that if you had a sweep, one of the things that's sort of concerning is the level of stimulus that we've had to combat COVID. I mean, obviously the debt it's going up a lot, and one of the longer term sort of implications is that we could see higher taxes on a corporate level, and then also on an individual level. And I think that a Democratic Congress and White House would probably be more amenable to having that, and justified to try to help pay for some of this stuff. But if that was to happen, that's not very market friendly, because when you start seeing taxes go up, profits are going down. So all else equal, a higher tax environment, whether, wouldn't be very market friendly. So.
Yeah, well, obviously there's a long way to go yet. And I guess, Grant, the best case scenario is limit the impact of the virus, get a vaccine and or a treatment, where we seem to be making some progress, and that could happen almost any day with so many companies working around the clock, and then getting the investments much more in line with the economic indicators.
Yeah. Well, I had a thought that kind of escaped me all of a sudden, but it's basically, while we talk about the potential of a uh, a immunization for COVID, uh, we start wondering about, well, how does it get manufactured and scaled and distributed out to everybody in a big enough volume to be able to actually change the virus. But I think that once there is a virus that is clinically proven to some extent, that there will be a strong positive expectation, coming back into the economy, into consumer behavior and corporate behavior, because we've already have a little bit of a model of that now, in terms of the various states talking about shutting down and opening up, and now even in the midst of having COVID deaths increasing day to day, states like California and Florida and other ones are opening up with the expectation that everything's going to be okay. So we deal in our technology in the measurement of human behavior. And so I think that effect will come on pretty quick if, in fact, some company comes up with a solution for COVID. And it'll happen, and the effect, the economic effect of it will be seen even well before it gets distributed.
Yeah, it seems to me, obviously, Charles, that the market works a large extent on expectation necessarily than the current underlying conditions. Obviously, as you've pointed out, there's a mismatch right now. So it's based on what people think, maybe / hope, will happen, and it's difficult, I think, to separate out, rationality when you're talking about prediction, which is the whole point of Intuality. What are your thoughts on how? I'm sure Grant's right that if there's a vaccination, certainly if there's a treatment, the market will definitely go up initially. Whether it would stay there or not, I think might be more related to fundamentals as we deal with this particular crisis. Is that what you'd think?
I do think that, and actually what you've seen is the various companies have made announcements about progress in coming up with a vaccination. You've seen the market jump accordingly because of that. So one of the things that I think that's actually adding to the disconnect we see right now, to your point, Howard, is that there is a lot of hope that is being built into prices right now, and a swift recovery. If anything, the risk, I think, is, markets are kind of priced to perfection, and they've already assumed that these things are going to happen and happen fairly quickly. So the question then becomes is, what if they don't? If it again takes longer to get a vaccine, if the virus was to mutate, if the infections were to spike, and I mean, there's all kinds of sort of worst case scenarios, but I think that's one of the challenges with the market right now, is because clearly there's a disconnect from the fundamentals, and it's because of expectations that things will recover faster, we'll get back to normal faster. And even with employment, that's one of the things that I think is challenging, is we've seen this spike in unemployment. Really, we haven't had unemployment this high since the Great Depression. Even during the 08-09 crisis, unemployment topped out at around 10%. So we're well beyond those numbers currently. And the expectation is that many of these people will be able to return to work fairly quickly. But I mean, I know of several business owners who are not and this is in the restaurant industry, and they're not expecting to reopen, and so they're laying off entire staff of people. And so then, okay, well, then they have to go find another job somewhere. Well, what's the probability they're going to be able to find another job? And so the temporary layoffs could indeed turn into more permanent layoffs. And it's not just in the leisure sector. I mean, that's kind of a lot of the industry that gets them, or the industries that get the most media attention. But I'm even seeing it in higher level white collar jobs, to where you're seeing people are getting laid off, projects are being delayed. So there's this sort of, I think, hope out there is a great word. But as the reality maybe sets in, that there could be some disappointment, and that's why my expectation has been, rather than the fundamentals coming up to meet the valuations where they are, it's the valuations coming down to sort of meet the fundamentals. And I'm not saying we may necessarily revisit the lows. It's hard to know. I mean, according to Intuality, we're going to go beyond the lows, but again, if we do see the Fed has committed, full support, without question, and I do think the Republicans and the Democrats are trying to come together to have additional, support for the people who have been laid off. I mean, I actually think there's a good chance, even though they've said the benefits will end in July, I think there's a chance they could get extended as we start to see more and more data. And if we are recovering at a slower pace than the V shape that a lot of people are expected, it wouldn't surprise me at all to see additional support, from the government too. So, and that would factor in, to Grant's point earlier, that would, as those things happen and the Intuality system gets more data, then, it would affect those predictions going forward. So.
Yeah, so it might be more like a W shape rather than a V. Start to go up a bit, then come down a bit, then go up a bit. As I said, I really don't have any academic experience or training in economics, but it is interesting as I follow the Dow and the markets each day, and I read the reports of why it's gone up or down. It seems to be to sort of follow a news cycle that, tensions with China, the market's gone down. Somebody thinks they've got a vaccine. It goes up. And
right.
For such a huge variable, it just seems whimsical almost. Now, of course, that's being written by a journalist who's got to make it as simple as possible. So I'm sure it isn't quite as simple as that. But it certainly shows to me how vulnerable the market is to news, really, and that is shaping their expectation.
Mm-hmm. Absolutely.
Yeah, I think this has been a good discussion. I just throw in the point that I made some time ago that I still wonder about from an economic standpoint, and that is how connected or disconnected is the market and financial effect and employment effect and so forth from COVID on the underlying basic market that was in process before the virus came on us. That's a question I think needs discussion, and that'll affect if in fact there is a disconnect. That means the recovery could be much faster once the virus is beaten in some manner, or it could mean just the opposite, that it is a permanent, lasting effect on the economy. I think it's going to be sort of somewhere in between, primarily because of turns out to be the larger use of technologies that have been available to us, specifically this kind of technology, to get work done at a very reasonable price. And in fact, even at lower cost than what used to do. Now, that doesn't apply to everybody in the workforce, obviously, but it has certainly been something that's been going on, and not only affecting people who work in the in the IT area or the high technology area, but also certainly within customer service, the service industries, and to some degree in the edges of manufacturing. So
Yeah.
that's something that hangs out there as a question for more discussion.
Well, we could go on indefinitely, but any last thoughts, Charles, on these complex issues?
I would just say, given where the uncertainty out there, one of the things that in my career, the markets have tended to treat uncertainty with caution. And 2020 has probably yielded some of the most uncertain times I've certainly ever been in my life. And one of the things that we're seeing is sort of this complete disregard for caution when it comes to the way that it's being priced in the market right now, and that's honestly really concerning to me. And the other thing, as I mentioned about the valuations from that chart, the statistical, it's almost a statistical anomaly where we are trading right now. And I mean, again, you can go back through the data, and it just, that does not happen. That we're sort of at these kind of levels, and anytime you have moments like that, I think that should cause people to be cautious, and because a lot of people that invest with me, they are trusting me with their life savings. Many of them are actually in retirement, and the retirement assets they have are their life savings. They need that money to live on for 20 or 30 years or more. And one of the things that it might be one thing for a 25-year-old who wants to, open up an E-Trade account and buy cruise stocks or whatever. But anyone who is I would say 55 and older, this is a very serious time, and a time to factor in the risk level, as well as return opportunities. I think sometimes the risk is not always noted to the degree that it should be, and when the risk imbalances are as they are now, I think that warrants caution for sure.
Yeah, and just on that note of the mismatch, the degree of mismatch between current valuation and the economic indicators, and you said it was like 4 standard deviations. So just comparing that to, let's say, a measure of intelligence, 4 standard deviations above the norm, you'd have an IQ of about 170 something. It's that far out. And so that's, maybe an analogy that people would help people understand that seeming mismatch between valuation and economic fundamentals. Grant, any last words from you?
No, other than to try to leave it on a light note, maybe that 4 standard deviations on IQ, maybe we're all suddenly getting smarter. Who knows?
Well, let's hope so. And if you keep listening to the show, you surely will. Thank you so much, Charles, for being with us. We'll make sure that the show notes have information about where people can reach you if they're interested in talking to you more about investments or your research. Thank you so much for being on, and we look forward to coming back again in a few short days and giving you more predictions from Intuality about all sorts of things. So for now, thank you so much, and take care.